Well, taking the market conversation forward, today I have with me in the studios Gautam Chhaochharia, Head of Global Markets at UBS, right here in the ET Now studios. Gautam, great to have you on ET Now. Thank you so much for your time. You just concluded your conference last week. Tell me, what's the chatter about India and the world?
So look, the biggest takeaway for us from the conference was that from corporate commentaries and investor commentaries, and we had a lot of record number of attendance from global investors also, looks like some early signs of hope. And this is not the classical second half recovery hope which we've seen in India for literally always.
Decades, yeah.
But this is tangible. And this is not something where the corporates are saying, okay, we'll see recovery in second half, which is a usual commentary. But between that, connecting the dots, there is some confidence or optimism building in, but very early signs. Even the global investors, locals we all know, they've been buying, etc. They're getting flows. But even the global investors which have stayed away from India, they haven't put any money for the last 4 or 5 years. We are seeing engagement, and not just the conference, but last 2-3 months on bottom-up stock ideas. So that's something which is, I thought, fairly new and worth highlighting. Let's see how we build on that.
Is that more a valuation-driven call, or is it more that earnings have come back? And I will talk to you about earnings in greater detail as well. The fact that now with the Nifty 50 pool, you've got, you know, the PAT uptick of about almost 8%, but margins are yet to catch up. So, I mean, what's driving this bottom-up case that the FIIs are building up now?
So look, when you say bottom-up, they want valuation or earnings comfort, ideally both. But in generally speaking, valuations are still rich in India. It's not that the valuations have corrected. We have seen market consolidating, but it's also accompanied by earnings cuts over the last 12 months odd. So it's not valuations have become attractive. But for the global investors, even other markets where they've been more engaged in, valuations have caught up. Again, India still at a premium, still not reasonably or attractively valued. But at least the relative sense is, okay, it's still a market where the long-term growth is there. So if there are opportunities bottom up, let's look at it. And again, the thing which is missing in the last year and a half, 2 years, which made the valuation stand out even more, was earnings. Again, the debate is still out whether earnings really pick up in a meaningful way, not just for the next 2 quarters, but going ahead. And that's where the early optimism signs are there.
But you know, to the point about valuation, what in the world is cheap? And I'm not just talking about equities, but across asset classes, it's all holding up.
That's true. And again, especially tech in the US, we all know. But again, look, if you look at, if you split out the tech
I mean,
part,
not just tech. Look at what's happening in Bitcoin. Look at what's happening in metals, precious metals. It's across the board, across asset classes.
But what happens is when investors look at opportunities in India, like whether it's automobiles or consumption or industrials, that's where the valuations become more stark. When you compare industrials in India, okay, they've done well, amazing growth, but trading at significant premium to similar comparables in China or emerging markets or even the US. That's where the valuations become more stark, not just on a headline index level.
So what is the view now, Gautam, on earnings? Because like I said, you know, margins are yet to catch up. Yes, on a PAT basis, we've seen that 8 to 10 odd % kind of a rough uptick.
So the real debate or the real catalyst for markets to really break out of the range bound it's been for the last few months and quarters would be if earnings go back to double digits or higher double digits. Okay, and that there are macro factors and there are micro factors. So the macro level, we have seen policy easing happen, both RBI and fiscal. It takes time to play out, and we are seeing early signs of that. But more than that, it will also reflect if, or for the macro level, if the credit standards start easing out or when credit growth picks up. Not just because there's demand, but also when the financial system starts easing out in being more aggressive in lending. Again, as I said in the beginning, there could be early signs that might happen in the next few quarters. And that will drive earnings because financials themselves are a big part of the index, and credit growth starts driving activity levels across the economy.
But again, you know, within financials also, there are the large cap, heavyweight private banks, and then this entire catch-up PSB rally, which is playing out, basis that credit growth is going to return. Within banks and within financials, why just banks, the entire BFSI space, how do you cut and dissect within what is a tactical pool and what's the long-term growth story?
So look, if you look at the banking system, whether it's growth, NIMs, NPLs, seems to be falling in place. I think the stress sectors like SME, etc., are still not bottomed out completely, but not worsening also possibly at a big picture level. So the way we tell our investors is when you look at, as you put it, public sector banks, private banks, smaller private banks, the non-bank financials, actually there's no that's not the classical way of us recommending to our investors that you buy public banks or private banks. Actually within that also it's much more stock specific. And I'll tell you why. For example, in private sector banks, we see commentary also in terms of loan growth. When you say credit standards easing, we are already seeing differential commentary. And again, so whichever banks step up in terms of growth will do better. Second aspect on the large private banks, some of them are more exposed to capital markets activity, which seems in place even now in terms of growth rates. So those banks should do better. And same framework we apply to non-bank financials or public sector banks as to which are the pockets within that which can grow faster. But in general, we see opportunities across all baskets, all of them. So in financials is one big theme, I think, which should play out in the next few quarters.
So what are the other sector overweights?
So beyond financials, consumption has been and still remains. But again, consumption is also not everything.
Yeah,
it's pockets again, like jewelry, for example, or quick commerce and stocks around that. Pockets of retail, pockets. Even staples. Some of the staples, they have amazing bottom-up strategies, which our analysts expect to play out. So at an overall level, consumption is an overweight. But where we would have relatively more cautious is auto pack. Again, we do like the premiumization and the EV part of the ecosystem, but not all stocks are as exposed. So the traditional autos names which are less exposed to EV or premiumization, them we are advising caution because the expectations are running ahead.
Okay, Gautam, we've spoken consumption. Talk to us about Capex because that's the other fillip which the government is at least attempting to do. So what there and what's the outlook there? Give us a sense.
So look, pockets have been doing well, like defense is a classic example. The other pocket which in fact we think markets are underestimating is around the entire power and energy, whether it's traditional or renewable. In fact, our analysts' work suggests that the pie will grow much faster than what Street is building in. And also where the margins will possibly surprise. So the profit pool forecast which our analyst has for the entire power ecosystem, that we are much ahead. But stepping aside, the power and defense part, I think are obvious areas to be optimistic about. The broader private corporate Capex, which is an often debated topic. So we'll make a couple of points. One is first, where the Street gets disappointed or markets get disappointed is comparing it with what happened in 2004, 5, 6, 7. But that cycle is difficult to come back in a hurry or difficult to foresee happening in the next couple of years. But from where the corporate Capex activity is today, there are two simple parts. One is very likely it picks up at a small pace. Second part is it's not that it's been doing badly. Private corporate Capex as a percentage of GDP is still largely steady, which means it has been not growing slower than GDP in the last couple of years at least. So there is room for it to grow, but don't expect a repeat of what happened in 03 to 07.
No, sure. And QSR, how should one look at valuations there, or should we just ignore valuations, only look at market share, only look at brand, only look at the way in which penetration is going up? Are those the only metrics one looks at where QSR, quick com is concerned?
No, so QSR, the quick service restaurants, we are less positive on.
Sure.
Quick commerce, absolutely we are.
Sure.
In fact, all the, if we look at our own analyst estimates and forecasts over the last year, 2 years, we have seen his forecast of TAM, the opportunity, keep going up. And he's been bullish throughout.
Sure.
So even the bullish analyst is increasing the TAM estimates. We did a trip around the conference, and we went to one of the smaller cities or towns. And we were shocked by the number of dark stores being opened up there, which seemed to be more versus what we would have thought initially. So that opportunity will keep on surprising positively. I think there's still a runway for both growth and numbers to surprise.
But that will come with its fair share of cash burn also, right? Yeah. And that's the profitability is where the question mark always comes in. So do you think they'll manage to suffice, or would it just be this constant Capex churn, fundraise, Capex, fundraise, Capex?
So the simple answer there is one, look, unit economics, which our analyst does work on, suggests that this segment can be profitable. Okay, because a lot of the cash burn today is not just discounts, but also the infrastructure being built out.
Sure.
Now, in 3 years, 5 years from now, what's the risk to that? Risk to that is many more players being aggressive there. That's the risk. Otherwise, if you have the current set of players, I think we have seen that play out in the food delivery space. There's a lot of concern around that. But ultimately, the industry structure and the economics, they're profitable.
Plays out, yeah.
So we won't worry about that today, but obviously you have to watch out for that. Because look, ultimately cash burn by aggressive discounting is not a long-term sustainable business for any. So you cannot have that play out for, you could have pockets of that. So, okay, today there's enough growth, but in 2 years, 3 years, it attracts more players, they start throwing even more cash, then is that will be a worry for the short term. But the unit economics is compelling.
And what about, and I know we're moving across stories very quickly, but talk to us about deep tech and its impact on IT. How do you play that in the Indian marketplace?
Yeah.
Because that's where the big challenge is. India has stayed away from the global rally largely because of that.
Yeah. Look, firstly, we have stayed away from the rally because we don't, the current AI phase or deep tech phase, whatever term, is the phase of building infrastructure.
Sure.
Whether it's chips or data centers, everything, it's Capex heavy infrastructure, which India did not have. Now, the school of thought around investors is that India should have ability to leverage that in terms of applications, which should actually work well for the broader businesses, economy, and even IT services companies, because they will be involved in using that to service companies globally. So the jury is out, to be frank. There are very strong schools of thought on both sides. From our perspective, what we are recommending investors is there's no obvious AI play in India at this stage, where, okay, AI boom, but what will happen is two things. One is we'll have to watch how IT services companies in India adapt to that in terms of applications. We haven't seen any material disruption yet, or not the extreme fears being talked about play out. And second part is even the rest of the businesses, like which are the banks which adopt AI faster. Very interesting things to watch out for. And some of the applications can be scaled up globally also, not just locally.
So like it's AI to the US and the Mag 7 derivative, is there that one segment or sector which is India's Mag 7?
India is more bottom-up and diversified, is the way to put it, has always been. So unlikely, it will be more broad-based.
And no internet consumer tech plays which are like must-haves in the portfolio?
So I'd guess the quick commerce ones or the food, they have become proxy to that.
Pretty much,
Pretty
yes.
much, yeah. And we've seen some of the new listings also attract huge broad-based interest. So they are becoming the proxies for that, but no similar new innovative models here being as such, no.
What are investors though saying about the greed that's playing out in the IPO market? And was there any chatter around that during the conference?
Everyone's aware, and it's a big topic of discussion, obviously. But again, it does not worry the institutional investors in a big way, because it's too fraction of their exposure. Okay, and for them to not participate also may not make sense, because if you participate, you get some pop-up, it is good enough. And some of them are good businesses also, despite the valuations. Yeah. So they are taking it's a good conversation topic, but they're not worried or jumping on it in a big way from their fundamental decision-making perspective.
So when it came to India, what was the chatter about?
Look, 6 months back, the chatter was about growth, trade deal. This time, growth, I think people are generally getting slightly more optimistic that growth will come back. Trade deal still remains front and center for everyone. But again, front and center more in terms of timing. I think unlike 3 months back, there's less of a worry about the contours of a deal. That, okay, the deal will happen, it should be reasonably good. When is the big debate?
But isn't that just sentimental, Gautam? Because how much of an impact does that have on our earnings is what I'm trying to guess. Not so much. That seems to be what the consensus seems to suggest.
So yeah, and it won't have an earnings impact for the foreseeable future. But I think from a long-term investor perspective, The debate around the trade deal is trade deal was being talked about, say, early this year, and for right reasons, as an opportunity for India to get good long-term growth because of exports opportunity opening up. So a lot of the India's big picture valuations is in terminal growth, not in next 2-3 years. So the debate is not about next 2-3 years. So whether a trade deal happens in a great way for India or in a very unfavorable way, at some stage will impact terminal growth. That's the debate. From a next 2-3 year perspective, yeah, absolutely right.
Makes sense. I wonder if you have a view on this big short position that Michael Burry has firmed up with regard to AI. Do you have one?
So look, our global strategists have written that they're not so bearish on AI as such. Valuations obviously are clearly rich, or whatever. Bubble is too strong a word. Froth of bubble is a lazy word, but valuations obviously are there. But we are at the very early stage of the AI cycle. So if the AI is a cycle changing or a big disruptor for the markets or economies globally, we are at a very early stage. We are very early stage of just building the infrastructure. We are far away from it becoming part of work processes, creating value for businesses, generally speaking. We don't know how big is that. If that's going to be as big as one school of thought says, then the current valuations are not a bubble, even though at this rich valuations. And we're talking about valuations for the infrastructure providers. Okay? But if the applications, like for all our businesses, it won't mean much, then clearly that's a bubble. And the application stage is still unknown. We can debate about it.
Right. Gautam, you made an interesting point about the entire financial services space and the fact that FIIs are coming back slowly, and it's the bottom-up stories. We did talk about the consumption piece as well. But within consumption, is it the premiumization theory which is still going to hold, or do you think the more bottom-up rural-specific stories as well will be given a chance this time?
Both, actually. So rural is a different part of the cycle and system. And premiumization always has worked and will always work in a growing, developing economy like India. That's the easier part of the growth, typically. Creating high volume growth, which means more number of jobs in a very simple way, is always more tougher versus people moving up the income ladder and premiumization playing out. So premiumization will absolutely play out. The rural part will go through cycles. At this stage, looks supportive for that's part of the economy.
And if I were to venture a guess as to when do FIs actually start coming back, this entire rate cut piece with regard to how it's playing out in the US macro environment, very unlikely that it's going to be a very easy rate cutting cycle, right? How should one look at the FI interest in India specifically, given that there are some factors with regard to AI and all which have now played out? So what next?
Okay. So let me answer in 3 parts. When you say FII money coming in, one is FIIs are putting a lot of money in emerging markets in general. Yeah. Okay. That's not happening, despite the US exceptionally, etc. Okay. That if it happens, if $100 comes to emerging markets, India gets its share. Even if it's underweight in EM, it will get some part. Sure. That's been a big drag on money coming in for the last, and I would say a bigger drag on money not coming into India for the last few years. Second is investors' view on overweight, underweight India versus other economies, which at this stage our EM strategy still thinks India should be underweight, just because of the valuation growth equation is still not making it attractive. And I don't disagree with him for the next few months or quarters at least. It's still expensive. And third is bottom up. And that's what I meant. So bottom up, India has always had good opportunities. That can attract. So even now in the last few months, wherever we have seen big IPOs or blocks happening for interesting companies and businesses, we have seen foreigners participate.
Sure, yeah.
But the simple answer is if we are expecting foreigners to come back in a big way, putting billions of dollars in India, like the locals have, that in the foreseeable future will only happen if emerging markets get that flows. Otherwise, don't expect that in a hurry.
Or a sizable India correction, which also you don't foresee
that's a different stage.
Yeah.
Exactly.
Right.
Where India becomes very attractive valuation-wise, then yes, but again, not in a hurry.
And Gautam, where within manufacturing is the largest opportunity currently where India is concerned? And where within manufacturing does the risk reward look better? Maybe two-part question, or maybe it's the same.
So at a macro level, it's very broad-based.
Yeah.
EMS or the electronic supply chain, iPhone supply chain, we all know. And that's a long cycle. We are at still very early stage of that. The entire supply chain has to be built out. Then the broader engineering space with machine parts, capital goods, that will take time. We're seeing very early signs, but not enough where it's achieving a size in itself, like what happened in electronics. But that's the other big opportunities. And then obviously the low-end stuff, textiles, etc. But that's will happen its own course. Shipbuilding, etc. Government is making a big push. A lot of geopolitics involved there also. So we'll see how it plays out. But broader manufacturing, there's a lot of opportunities out there. From a stock market perspective, obviously the ways to play that is largely around the electronics right now. Again, very selectively, even in the machining / electrical equipment or the power ecosystem, we have seen some companies which are very well positioned to gather export markets. So there will be pockets, but again, stock specific rather than a sector overlay.
What are the red flags when it comes to India?
The red flag is employment primarily. That's the one thing which has become a discussion point among global investors in the last couple of years, 3 years, because it's not just what you read in India locally, but it's also a theme which has been playing out in major parts of the world economy also. So it's not just India specific. But India has that huge demographic advantage also, which has been a key driver for the growth optimism. So if employment generation does not happen at pace, then that demographic benefit is not capitalized completely.
And Gautam, what do you make of pockets in this Q2 set of earnings, which have really stood out for you? Give us a sense of what those pockets were, which you didn't really anticipate will stand out, but have stood out.
Look, commentary-wise, I think the sector which stands out to me is financials.
Yeah.
Yeah, because both in terms of numbers as well as commentary, NIMs bottoming out, commentary or numbers on NPL cycle, early signs of growth, and selectively some part of the financial services mentioning about growth. Actually, numbers might be better than what the street is expecting. So, to me, that's a one big sector.
Okay, Gautam, great to have you in the studios today. Thanks for all that insight. Good chatting with you.
Thank you.
Thank you. Okay, let's just revisit where the